Daily with the Unity Group of Legacy Mutual Mortgage, and let's talk about what the July mortgage market update looks like or looked like. So mortgage rates did move higher during July. If you look at the chart behind me, you'll see going down in July on the chart and a lot of red. Red is bad for mortgage rates. So we've rebounded some from July, but let's talk about what happened in July. So we started the month in the mid 6% range, and then with inflation concerns and energy prices and expectations about the Federal Reserve putting upward pressure on the bond market, mortgage rates moved to the high sixes. Now, inflation is still the big story. It has improved from its earlier highs, but it's still above the Fed's 2% target. The Fed specifically pointed to elevated inflation and energy-related pressure in its July meeting. So inflation continues to be the biggest obstacle to lower mortgage rates. We've seen some encouraging inflation numbers, but we're still above the Fed's 2% target, and energy prices have added another layer of uncertainty. Now, the Fed also had a meeting in July. The Fed Reserve held rates steady again in July, but the meeting was noticeably more hawkish. 3 of the Fed members actually wanted to have an increase by 1/4 point. So the conversation shifted from when the Fed may want to lower rates to potentially another increase to control inflation. This is a powerful point because it explains why mortgage rates haven't fallen despite some of the softer economic data. Now, let's talk about September. The Fed has another meeting in September, and are they going to increase rates or not? There is a possibility that the Fed could increase rates in its September meeting, but here's something that's really important. Mortgage rates don't wait for the Fed meeting to actually move. They price in the expectations ahead of time, so today's mortgage rates already reflect what they're expecting them to do in September. If the Fed does raise rates and the market already expects that, then the rates don't change. The bigger moves usually happen when the Fed surprises the market. So if they drop rates, right? Or if they keep them the same, that could improve them a little bit. In terms of jobs and the economy, we're seeing some weakness in employment and other parts of the economy, which is typically good news for mortgage rates. That's why a September Fed rate increase isn't guaranteed and probably not super likely at this point based on what economists are predicting. The Fed is essentially balancing a slowing economy against inflation that's still running too high and just trying to strike the balance there. So heading into September, I wouldn't really focus necessarily on whether the Fed raises or hold rates steady. A lot of that expectation is already reflected in the market for what rates are right now. What could really move rates is new information, like if inflation comes down or we have bad employment data, so a softer employment report, right? This can cause the market to move faster. So we'll keep our eye on it, keep you posted. Have a great one.